Renewed fears of aggressive rate hikes by the US Fed in the backdrop of the recent macroeconomic data could see the Indian equity markets remain range-bound amid volatility over the next few months. This comes as the possibility of El Nino also risks stoking inflation back home and could prompt the RBI to continue with its hawkish stance. This, analysts believe, presents a good opportunity for investors to shift their focus from equities to debt.
When you look at broad markets and look at the scenario at this moment, it being an rising regime, in such a scenario, it becomes difficult for equity markets to get re-rated. No doubt, India data points are strong, but in a rising interest rate regime, there is that much that can happen to the equity market. So we do look at the equity markets to remain more or less sideways for this financial year, unless there is some trigger which comes in globally, which does not look likely looking at the similar data points globally. I mean, some of the data points from US are not exactly very strong, and their interest rates suggest that it is a 4-decadal high, and the impact of that will take some time to not only smoothen out but to reverse. In that scenario, I feel investors are in a good state because the debt side of the market gives them some fantastic yields to lock in. And the equity market, when you look at projecting India over a period of 5-10 years, is definitely headed to go from 2.5-3 trillion to 6 trillion. And at this point, the global markets also look attractive. From an investor perspective, it's a good time for long-term investors to dig in and accumulate. And the debt side of the market is giving them fairly good opportunities from locking into some very decent yields at this moment.
US Fed Chair Jerome Powell recently said that the Federal Open Market Committee, or FOMC, is likely to take rates higher than previously anticipated as he left the door open for a 50 bps rate hike later this month. Last week, the non-farm payrolls in the US increased by 311,000, higher than the expected 205,000. This has put fears of a higher than expected rate hike by the US Fed back on the table. As per Philip Murray of Rabobank International, if longer-term interest rates remain too low to slow down the economy and squeeze inflation out of the system, the federal funds rate may even have to go higher than most of us can currently imagine. Meanwhile, returns from the Indian benchmark indices have been dismal so far in 2023. While the BSE Sensex has slipped around 2%, the Nifty 50 has lost nearly 3% in calendar year 2023. Amid the uncertainty, experts say that investors can also look at investing in both debt and equity segments. Markets are pricing in a 50 bps rate hike in the next Fed meeting. Investors may adopt a twin strategy of attractive fixed income returns with incremental investable funds while continuing to buy high-quality stocks on market weakness. Therefore, investors should remain stock selective and can also look at the debt segment as the equity market could witness heightened volatility ahead amid fresh risks of longer than expected rate hikes. On Tuesday, the markets are likely to remain cautious ahead of the CPI inflation print in the US, which could reaffirm Fed's resolve on rates.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.